I still think we're going to get these rate hikes, but and I think the outlook for plain vanilla U.S. investments is pretty rough. But what you do is you have to be a little bit more thoughtful. I've always thought, investing requires courage and brains, but it requires different quantities at different times. When you're really in a slump like 2009, you really just needed courage because it was a no-brainer that the market was going to come back up. Now is a time you've really got to differentiate. So first of all, within the US, steer clear of things that people are buying for yield. Focus on the cyclicals, the financials, consumer discretionary, which will do better with rising rates. Also look at Europe. It is a lot cheaper than the US. Emerging markets are a lot cheaper than the US. I know they haven't done as well as the US in the last few years, but you've got to have the brains to say, I'm going to take some of the money, out of the US and look at other places around the world where I will get better long-term returns.
No question the European equities are cheaper than the United States, but do they have the same growth potential as US equities do?
Yeah, in the next few years, I absolutely think they do. First of all, in the next year, we're going to see an all-time high in US earnings. European earnings would have to go up about 50% from here just to get back to 2011. But more than that, they've got about 9.5% unemployment. We've got 4.8% unemployment. They've got room to grow as an economy. They're still they're in the second innings of an economic expansion.
So explain that room to grow.
Yeah.
Because normally we're told it's got to be a combination of two things: the size of the labor force, that is demographics, and productivity. And does Europe have both of those?
No, a third thing: slack. If you've got a lot of unemployed workers, you get a few years in which you can put those workers back to work. In fact, that's why the U.S. has grown by 2.1% in the course of this expansion. It would have grown a lot less had it not been from putting unemployed workers back to work. So eventually, Europe's going to. Europe is a tortoise, but it's a tortoise which has got the ability to run a little faster for the next few years until it gets to full employment, and that's quite a few years away.
I love all the narratives. Tortoise is like your jam. Whenever you come on,
Exactly.
that's what you say. Mike, so back here to the U.S., have the markets re-rated the potential of more rate hikes this year, potentially an earlier unwind of the balance sheet if we get that March hike?
Nobody has really priced in a fourth rate hike this year. There's more agreement now that they will do 3. But what you're starting to see, and we saw this with Morgan Stanley yesterday, is a fourth rate hike next year instead of just 3, because they think the economy has the potential to grow faster if the administration can carry on and carry through with its fiscal policies and give the economy stimulus that it doesn't really need. Then you're going to boost the growth rate, at least in the short run, and the Fed may have to lean against that.
But I think the Fed's got an important messaging problem. The Fed has been, this has been the Fed that cried hawk for years. And that's the reason why, up until this week, people didn't really believe a March rate hike. But really, they've met all their conditions here. But they have to, I think, have the nerve. Unless there's a crisis, I believe at every press conference meeting this year, they will raise rates. Because to do otherwise would make them completely unpredictable going forward. And also, eventually we'll have a recession. They're going to need to cut rates. If they don't get going again, if they don't rearm themselves, we're not going to be in a position to use monetary policy to stimulate the economy down the road. So I think they'll hold firm here. I think we get a quarter point at every press conference meeting unless there's a crisis.
Well, the one thing that could stand in that way is the great uncertainty that we have out there. There's more uncertainty about fiscal policy and what's going to happen to the economy down the road than we've seen in many, many years. So yes, Dave is probably right. We get something in March. We might get something in June. Then as the year goes on, I don't know that you can be really certain because you don't know what's going to come out of Washington.
So does all this back and forth change the long-term projection, the terminal rate, where they're headed toward?
Yes, because you get a few years until something goes wrong. So the faster they get there, the more chance they have to get up to that term rate. I don't actually think they're going to get to somewhere in the 3 to 4% range, because I think something will happen before then, which is going to cause them to pause or maybe cause the economy to pause. But the faster they get going, the higher we'll end up.